Good afternoon. This is Brian Dallum with FS Grain on a Tuesday market update. Today is November 2nd of 2021. We're going to move forward here and go over a quick shot of our local cash basis values here in Northern Illinois. Story of two different commodities here, really. Soybeans continue to lack a little bit here in decent basis values. We had, it appears, much better than expected yields in Northern Illinois from what we've seen with all the farmers, which is great in terms of production. The problem is the outlets for those soybeans that we normally bank on every year just weren't there. One of those is our container market. The containers are still in just a big mess of logistics right now due to the pandemic. So if you go back to March of 2020 when the pandemic first started, we saw a massive slowdown in production of goods all over the world as factories were shut down. As we went through the summer and into the fall, we saw a ramp up in U.S. spending, lots of goods being bought by U.S. consumers. So we tried to ramp things back up again, but the problem is there's hundreds of ships right now out at port full of import goods in the port of LA Long Beach and various ports around the United States waiting to be offloaded. And we're struggling to get that done in a timely manner due to lack of trucking, port issues still. So this is a problem that appears to have a long tail on it. So unfortunately, those full import containers mean there's no empties for us to load at a normal pace to export back out to countries in Southeast Asia. So a lack of containers right now has been a poor spot here in Northern Illinois. Also, the river export market, it's been slower than what we would like to see. Much of that is due to the fact that China's purchases have been slow. While they have made some new purchases here and there, it's not been at the pace that we normally like to see. Surely not even close to a pace that would meet the phase one trade agreements, which was put in place here by the previous administration. I don't think anyone in the market expects them to magically meet that obligation, but at the same time, we were hoping to see them continue to buy U.S. soybeans on a normal pace, but that doesn't appear to be the case right now. So that's that weak export market in conjunction with kind of the logistical mess that happened as the hurricane about a month ago blew through the Gulf and really shut things down. They are back up and loading, which is good. Just we need more sales on to kind of juice up that basis value. Now, corn, on the other hand, different ballgame. The ethanol market has really come rolling back with better margins due to the higher crude market, so they're all wanting to buy more corn. The river appears to, in the short term, be a little bit more aggressive for November. Probably had something to do with the lack of loading on the Ohio River. Right now, we saw, or excuse me, this past 3 days ago, good storm system moved through Ohio and Indiana, so it really slowed harvest pace down there, thus slowing the loadings on the Ohio River. So that's good for us here in Northern Illinois, up and down the Illinois River, as there will be some short-term covering there due to the slow harvest pace out to the east. And then rail values continue to be competitive. You know, that's been a bright spot as well, as we've seen good rail markets. So as everyone continues to load trains, it appears that we've got good basis values here for the foreseeable future in Northern Illinois. So that's a good thing for the local farmer. We switch over to the future side of things right now. Let's look at old crop DEES 21 futures. I've got some lines and circles drawn out here to try and make it easier to understand, but you can see we posted our high on December futures back this summer in it would have been late May, early June, somewhere around just shy of 640, 635 levels. We've continued to trend lower, if you follow that green line down to where we've got to this fall. Previous high there's around $6 now. About the last 5 days, 10 days, we've really seen a heck of a move higher, breaking through that uptrending line, downtrending line, and kind of reaching back up here toward this recent high of right around 595. So off a little bit today, but the price action recently has been pretty friendly for corn nearby. So, you know, we're seeing values that are 560 to 570 cash in the fall. You know, I'm not going to say futures can't go higher, but boy, that's a great value to sell, especially if your yields were good. If we switch over to new crop corn here, you'll see the new crop corn market has also kind of taken the same thing, trending higher. Previous highs there, the uptrending line somewhere through 540. We blasted through that and continue higher around the 548 here today. So maybe something to take a look at. You get your first 10, 15, 20%, maybe at the most sales on in some shape or fashion for next year. Again, we got to look close at what our input costs are for corn, because holy smokes, if you haven't had that conversation with your fertilizer dealer, it's going to be a tough one. Seeing costs skyrocket in terms of inputs for corn next year. So I think that's a little bit of what this rally of late has been, with the realization that we could lose corn acres next year just to the cost of putting them in. So the market's going to have to react to that if it's not comfortable losing those acres. So if we look at soybeans, you can see old crop soybeans that we're finishing harvest on now. Definitely been a downtrending line here since the highs this summer. We bounced off a recent low here around the 1180 mark, rallied back up today around 1244. So still decent levels there, certainly off the highs that we saw this summer. But you know, if $12 cash is a number you like, I wouldn't argue with anyone selling that. As we move forward, to me, soybeans are the most urgent thing in our marketing plan that needs the most attention today. With our crop being bigger, or maybe production bigger than we originally thought, as yields were better than anyone had guessed. We look then to this spring as the planting pace in South America well ahead of normal average. They've gotten good rains to get them started, and with the high prices, you can bet they're going to plant a lot of beans in South America, so they're off to a good start. And then you couple that with our spring planting, as guys are going to sit down and look at costs of growing corn versus soybeans. The potential to grow beans is just way higher there, and we could see way higher acres planted. So I want you to keep that in mind on soybeans going forward. Again, not saying it's impossible for a rally to happen, but if we like the levels we're at, I think the urgency of getting soybeans marketed or floors protected is probably the one we want to look at the most, both new crop and old. If you are going to swing acres to soybeans next year, we need to really look hard at getting some of that covered. You know, it's just good risk management. If we've got good profitable levels here around 1247, which would get you a little bit above a $12 cash price, taking some risk off the table for that downside is a great idea. Quick look back at energies. I think a month ago on my last video, I had talked about natural gas and crude oil. So we're going to look at where they've moved since then. Here about a month ago, we were making all-time highs in the natural gas market. A lot of this due to various different things around the world. At this time, we saw Russia come in and say, oh, we can turn the spigot back on. Well, then they crashed lower. The thing here to remind is natural gas is used in the production of so many different products around the world, especially in ag. So the high cost of natural gas is not a good thing for ag, but we have seen it sink lower. Warmer forecasts here after we get through this week, I think, are helping natural gas as well. But just one thing to keep an eye on outside of our markets. Of course, crude oil affects so many things around the world. We've seen a steady march higher here as we've gone through the summer into this fall, from $60 a barrel all the way up to a high of $85 a barrel. That's, you know, the highest level we've traded in 10 years or so. So we're chopping around between $80 and $85 a barrel. But the good thing in terms of the ag world is that as we swim in these higher crude levels, yes, it costs us more at the pump, but this is also the reason that the ethanol markets are screaming back higher. Down here at $60 a barrel, margins aren't so good. When crude oil is this expensive, we see ethanol margins increase quite a bit, which means they're going to be trying to crush every bit of corn they can get their hands on. And I guess here's what I'll leave you with. We don't think about wheat as often here in Northern Illinois, but it is the leader right now. Winter wheat ratings were 45%, good to excellent. That's the fourth lowest since 1986. And we see futures reacting to that as we're up here just shy of the $8 level, which would be the highest trade since 2012. So wheat, which, you know, that problem can easily be fixed as we plant wheat somewhere in the world every day. But right now, there is a shortage of wheat, and we're looking at a pretty rough start to the U.S. crop. So today, wheat's the leader. Corn is more than happy to march higher along with, and I think soybeans are kicking and screaming all the way higher because they're looking at the realization of world soybean stocks growing next year. So I hope we had some things of interest here for you today. Again, I want to leave you with the thought, please be safe. We know everyone is going to be finishing or getting close to finishing their harvest here with the good weather this week. We always want you to think first about safety so that we can go back to our families and get to harvest another crop next year. So again, we appreciate your business. This has been Brian Dallin with FS Grain on another market update.